and the emerging markets are very worried about this, that there's going to be this herding behavior, or returns chasing behavior that's just it's just going to lead to a massive flow of capital that has nothing to do with what's going on in the countries. And that's a reasonable view, but all of the research on this is really flawed because it uses data that can't speak to any of these things. So if you think about these concepts, herding, when different investors all do the same thing at the same time, or trend following investments, you actually have to know what the person's portfolio is to make a statement about that. You can't look at, for example, my deposits and withdrawals from one account and pretend to know anything about how I reallocate my whole portfolio. If you just see the flow of money in and out of one account, you don't know the whole picture, and you don't know what they're reacting to, what they're moving out of. Is it the case that they have more wealth and they're just allocating it to different places? It's really hard to say anything about portfolio behavior unless you have the portfolio. And all this data is based on flow data that can't actually speak to some of these forces. So that would just be a word of caution. Think when we see this research that talks about herding and returns chasing, take it with a grain of salt, because the data is just not up to snuff for addressing those questions. And the work that I am doing with Kristin suggests that. So one of the things that people are worried about is, okay, the Fed unleashes QE2. It's going to keep interest rates low in the U.S. for a much longer time. There's going to be a search for yield, and that's what's going to spark the massive capital flows. When you actually go back and look at the last 2+ decades of data and try to think about these abnormal capital flow episodes, it's not U.S. monetary policy that's driving these episodes. It's not the Fed funds rate. It's not the U.S. long-term rate or anything like that. What it seems to be is risk appetite. And when risk appetite is on, when investors are less risk averse, then that's when you see these massive flows to emerging markets. An example, and so that statement's based on a gazillion data points and a lot of hard work. But a simple example is we had enormously accommodative monetary policy in the middle of the crisis. We had very low interest rates. We had the Fed starting an unprecedented expansion of monetary policy in the monetary base. It didn't lead to a wave of flows in emerging markets because risk appetite, there was a lot of risk aversion at that time, right? So now, risk appetite, risk aversion, these are constructs, right? It's not like we can actually accurately measure these things. There's certainly room for Fed policy influencing risk appetite, so there could be a channel there. But when you really look at it, it's not the monetary policy in the core or in the U.S., but it's more this risk appetite. Right now, what we're seeing is risk appetite is on. That is, investors are seeking riskier and riskier investments, and that coupled with conditions in emerging markets, many of the emerging markets have very attractive fundamentals of strong growth, relatively high policy rates. We are starting to see flows into emerging markets. How much flows are we seeing? I look forward to, so I hope that one of the discussants maybe has daily data for this region. What I'm relying on here is monthly data that I've aggregated up to quarterly data, and it's only from the U.S. So this table gets at the question, are we seeing a massive flow of money going from the U.S. into emerging markets? And the answer is, to date in 2010, we do see some equity investment, certainly in Brazil, especially in Q3, and in Asia ex-Japan. We're seeing $10 billion in Q3 going to Brazilian equities, almost $8 billion going to Asia ex-Japan. We're not seeing it in we're not seeing large bond flows to this region. We are seeing it to Chile, Mexico, and Peru and Venezuela. My guess is that some of those at least are dollar denominated, but some of those will be in the local currency. So we're not seeing a massive wave of capital coming out of the U.S. The capital flows that we've seen are in line with what we've seen in the past. There's really no change in behavior there. It doesn't mean it won't happen, right? So I think that there's a lot of advice out there to send all your money to emerging markets. So if you're in the U.S. and listening to advice, it's get your money out of the country as fast as possible. But we don't actually see this in the data yet. We don't see that people are really taking that advice. Now, this is probably one of the more difficult things for policymakers really to grapple with. So we see these flows coming in. They come in. I wouldn't say that they're excessive in any sense. But one thing that the emerging markets have been doing is accumulating large reserves. So the money, and effectively, if you're not an economist, thinking about it as the money's flowing in and they're sending it back out by buying U.S. Treasury bonds or something like that. And thus, when the money flows in, it tends to put upward pressure on the currency. If they send it right back out, essentially, it can negate that impact on the currency, and the currency can stay somewhat stable. And so emerging markets have been accumulating a lot of reserves. Now, the problem with this is it's inflationary. I won't get into the exact details, and I won't ask our guest from the Banco Central to get into the details on this either, but essentially it is inflationary. The central bank can try to mop up the liquidity, squeeze the liquidity from the system to make it less inflationary, but over time it's going to be inflationary. And the right chart here shows the red line is global consumer price inflation. It's nowhere near as high as it was prior to the crisis, but it's moving up again, and that's problematic. And the dashed line is food price inflation that is now up to 20%. Food price inflation hurts the poor disproportionately. The poor spend more on food than wealthier individuals, and so when you have food price inflation, this really tears at the poor. And that's a difficult thing because accumulating the reserves to maintain, to keep your currency from appreciating is at the same time going to be inflationary. It's going to stoke inflation, and that's going to hurt the poorest segments of the population first and foremost. So with all that, there's no joy in any of those pictures, and I'm not sure that I have any joy in this presentation. But a way forward. So in my opinion, the U.S. and China should agree. They should just agree that China is manipulating its currency overtly through its exchange rate policy, and the U.S. is manipulating its currency covertly through its combination of fiscal and monetary policies. It's a fact that should just be an agreement. It's not I don't think it should be the most important issue, but they should agree on that. For the emerging markets, the emerging markets are in a tough place. They're going to have to weigh some options, and none of these are all that attractive. Accumulate more reserves, it's inflationary. Impose capital controls. There's always problems with putting on new taxes and that outlive their usefulness. Or allow the currency appreciation, in which case the exporters will get a little upset. To drill down just a little bit more deeply, so China, I think, from my perspective, should realize it's too big to continue exporting to the rest of the world as its main engine of growth. I would say, if it put forward policies that would allow the median Chinese person to have better opportunities, that would naturally alleviate some of the pressures that on the exchange rate and on the current accounts. It would be addressing a more fundamental issue. So allow financial sector development, enable better access to finance. With better access to finance, the people have to save less. They don't have to save so much for a rainy day if they have better access to finance. And also, if the social safety net is strengthened. There's a lot of fundamental reasons why Chinese save a lot. Addressing those and enabling more opportunities for the median person there would go a long way to alleviating some of these pressures in the global economy. Notice this slide says nothing about the exchange rate. It just says make financial access more available. And address the lack of social safety net, and then some other things will follow naturally. The U.S. should allow a normalization of monetary policy. This morning, I had a different bullet here last night, but this morning I saw Ben Bernanke said basically exactly the same thing that I had on the bullet last Friday at the ECB. One way to allow monetary policy to normalize in the U.S. is to end the fiscal paralysis and implement fiscal stimulus. The problem is, in the U.S., to propose fiscal stimulus now, you also have to have a credible plan, a credible medium to long-term plan to rein in the budget deficits of the future. Right? The problem in the U.S. is not the current budget deficit. It is not. It's the medium-term dynamics with the deficit. It's because of things like Social Security, Medicare. Right now, we have it set up in the U.S. that we want to spend a lot more than we tax, and that it just can't. There has to be some reworking of tax policies and other policies. And with any luck, it'll encourage savings rather than consumption. If we have more savings in the U.S., then these imbalances will naturally be lessened. For emerging markets are in a tougher situation, I think, than China or the U.S. If inflation becomes a problem, which it may well, then emerging markets will want to slow down on the reserve accumulation and let the currency appreciate. This will naturally rein in inflation. It would be unpopular with exporters, but the poor would benefit disproportionately from a policy like this. Or they can go ahead and impose capital controls, but capital controls. So the final bullet: financial engineers are paid to get around these things. They will get around these things, and so you have to question how useful the controls are. And it's also, you end up, it's often the case, you end up with a set of policies that made sense at the time, but then outlived their usefulness over time, and they're not taken off the books. And so it's a problem with any policy, but also with capital controls. So final slide, the prospects of, the way I see this, I think that, so U.S., Europe, and Japan, they have fiscal straitjackets right now. Barring some unexpected event, there's paralysis in each of these areas on the fiscal side. And so what that leaves is what I would call non-coordinated super expansionary monetary policy. That is, so right now it's the Fed who's said we're going to throw everything we can at the problem. And the ECB is saying, no, we're not going to do this, and the Bank of Japan is backing off a bit too. And so right now it's the Fed that's doing all this, but then it's going to turn to, things will likely get bad enough in Europe that the ECB is going to have to give up its stance and say, all right, we're going to engage in super expansionary monetary policy now. And so what we'll see is kind of a sequence of expansionary monetary policies that's just going to lead to huge volatility, I think, in the currency and possibly to trade protectionism. Countries doing better, for example, many emerging markets, they're either going to be faced with inflows and inflation if this plays out, and they're going to have to choose between implementing capital controls, accumulating more reserves, and or allowing currency appreciation. None of these are appealing, I don't think, but these are the difficult choices that will have to be made. Okay, so that's where I show that I'm a linguist without actually saying it, and thank you.